All right, well, that was a really quiet start to the week. Not very much. Small down moves on the S&P and the Nasdaq. A small up move on the Russell. Some pretty interesting moves in Bitcoin and gold. So a lot of people kind of connecting those two today. Interesting moves as well in bonds, especially following the big kind of breakout type move to the downside, kind of blow off type move to the downside that we had yesterday or Friday. So other than that, a pretty quiet day as a lot of these major indexes are moving up towards resistance levels, whether that be moving averages or Fibonacci retracement levels or whatever. So small day, small range, small volume, very typical of how we perform heading into resistance. So we'll talk about that. I'll show you what I'm talking about in today's video. Our trade idea is a stock that we can kind of take advantage of this quiet period with a stock that's got a pretty sideways range itself throughout the past year. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, February the 7th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's go ahead and start by taking a look at the S&P 500 with the market forecast indicator like we always do. You can see the S&P was down today. We got dark pink shading again because the intermediate line turned back down before getting into bullish territory here. In fact, it stayed below its long-term market sentiment line. So if you notice, the short-term sentiment still bearish. Both momentum line and near-term line are in bearish territory. We are still, we still kind of are in this Fibonacci retracement area between the 38 and 62. So we're still retracing. We're not breaking out to the upside. We're not breaking down to the downside either. You have resistance up here at 62, and then eventually the trend changes at 78. You have a little bit of support down here at yesterday's low or Friday's low point, and the bearish trend continues below the 23. So as long as we're stuck in the middle, there's really not a whole lot going on. Today's range was very small, well below half. We are still 2.5% below the moving average, so we're still a significant amount below that there. If you take a look at the NASDAQ 100, you see its intermediate line also turned down, but it's actually still in bearish territory and also below its market sentiment line too. So, and it's actually still holding the 38% retracement for resistance. So it started to retrace, but it's still got some resistance in this area. You can see also down the 0.8%. The Russell 2000 was actually up today, but its intermediate line and market sentiment line are still in bearish territory. Market sentiment line is the lower reversal zone. The intermediate line, obviously, well inside the 40th percentile. Short-term sentiment did rally, but not significantly, not even the bullish territory, much less to, overbought, the overbought zone or even up to extreme highs. And you can see we're actually still below the 23% retracement. Very low, small day on the range. So very, very quiet day. Really not a whole lot going on. Typical Monday, typically, whenever you don't have a big weekend news event to spark any kind of change in sentiment. It is interesting here on the Russell that, obviously the Russell has broken its 23% line. You can see the 30-day moving average now is almost below the 23% line. And remember, that's going to be a resistance line coming back up. The moving average will be. So that again shows how significantly bearish the Russell is. And the S&P is obviously not below the 23% retracement. And that's the 23% retracement of the post-COVID rally. So a multi-year move to the upside, very significant move to the upside. And you can see how high that moving average is. The NASDAQ is the one that has flirted with getting below that line. Its moving average is still easily above it. So that kind of goes to show again just how bearish the Russell is right now. It's almost about to cross below it, and again puts pressure on the small cap index there. Let's take a look at the weekly candles, and you can see again very small transition candle, nothing very significant. The PPO's falling. It's a very small positive differential there. Same thing on the NASDAQ. It's actually a very small negative differential. No green arrow, so we're not reversing this bearish pullback. Same thing with the S&P. The Russell 2000, of course, remember, has its, we have the death cross. It still has a negative differential, just not as big. And you have a falling PPO. And you're still easily a red arrow. And now, again, like I said, that gap is widening between the 10 and the 40 week. The 10 week is below the 23% retracement, and the 40 week is getting close. Again, those are going to be pretty significant resistance levels on the way back up. Let's take a look at the 3 green arrow charts. You can see the MACD histogram. Like we have clear line, like clear shading. We don't have green or pink shading, which means we have green arrows, 2 green arrows on all these indexes. But the MACD histogram is dropping on all 3 of these except for the Russell. Just a small increase in the Russell, but the histogram you can see is falling on the other 3. If you take a look at the 2-line version of this chart, you can see the S&P is still trading below its 17-day moving average. It's actually back below the 8. The MACD is above its moving average, so we are in a bearish convergence mode, and we're trying to trading between the 17 and the 200-day on the S&P. The Qs are below the 200-day and back below its 8-day as well, and back below the point of control. So, you know, we're in a bearish convergence mode too, because we're not, you know, the MACD is not below its moving average, but we're also still below the 17-day exponential, which is the bigger number in the MACD down there. And then if you look at the IWM, it's, you know, again, also, even though it's up today, it's still below its 8-day moving average, which is also still below this 17. MACD is above its moving average. We have the histogram, we have the green arrow there, but we're not above the 17-day, nor are we above any of these moving averages or Fibonacci resistance levels. So we're still pretty easily bearish, even if we had a small little rally on IWM here today. If you take a look at some of the other oscillators, you can see the S&P, we're still easily above 25 on the negative directional index, below 20 on the positive. Same thing on the IWM, and same thing on the Qs, right? They're both still in bearish territory with the ADX up above 25. When you look at the RSI and the CCI, you can see we're in neutral territory for the S&P, but not unable to get into bullish levels. Same thing for the NASDAQ, and same thing for that matter for the Russell. So they're in the middle of these charts, but they're not breaking out above 50 or above 100 on these to get to bullish levels. When you look at the Ichimoku cloud, we're still below the cloud. We're below the blue line, not back below the green. We do have, you know, pretty close to a mature trend going on here on SPY. IWM still does have a mature trend, and we are well below the blue line and well below the cloud. And then the Qs, we are well below the cloud too, well below the blue line, and we have a mature trend going here as well, with being below -5 and above 80. Very, very strong bearish trends going, and we haven't changed, right? This little rally we've had has not ended that move. SPY is in the lower half of its Bollinger bandwidth. The Qs also easily in the lower half of the bandwidth and below its point of control, and IWM is way below its point of control, well below the value area the past year, and easily in the lower half of its chart too. That's why, again, another reason why the small caps are just so bearish relative to large caps, and there's still room to go to the downside to get to the next layer of significant volume support, which is going to be down at the bottom of this Fibonacci area. I don't think we get that far down. I think in the worst case scenario we hit the 50% line, which is kind of lining up with the pre-COVID peak on the Russell 2000. And again, that would be kind of a worst case scenario there in my opinion. Let's take a look at today's intraday move. Not very much of one. Completely an inside day. Lower high, higher low. We closed in the middle. Like so far, it's, I mean, Friday was inside the week. This is inside Friday. I mean, it's about as inside of a move as you could possibly get. The Qs looked exactly the same, and IWM is a little bit, you know, we did get a higher high and a higher low on IWM, but we did close below the high, and again, easily within last week's range. So very, very neutral days all across the board. The S&P's volume was well below average, 84 million. The trading range was only 5 points, so not, you know, no gap to include there. So when you look at those numbers in context, you know, 5 points is way down here. The volume at 84 million is way down here. It's a very quiet day, you know, which is very typical when you've made a run to resistance and then you lack the momentum to get you through it. And we hold there. Now, we don't have enough bearishness yet to sell a new leg lower from a sentiment standpoint, but we also don't have enough bullish sentiment to get us through that resistance. And so we're stuck, you know, and usually that will lead, and you know, within a day or two to a move in either direction. And as of right now, again, you expect resistance to hold until it doesn't, so you'd expect that move to be in the downward direction, again, potentially after another day or two. Volatility is still actually very bullish for investors, for equities. It's below the 90th percentile. That's bullish territory. So it's bearish territory for volatility. That's bullish for stocks. We are above 20 though, so it is relatively high. Last time we were, in this 90th percentile, we were kind of in that area too. But we've kind of held this 85% for support this time, and we'll see if we end up holding here and making a rally through the neutral zone back above the 95th percentile by the time all is said and done. So just to kind of recap, obviously we're in this bearish trend, this bearish pullback. It actually is a correction mode. If you look at, again, at the long-term view, not this one, the long-term view for this, if I were to go 5 years in the weekly chart, and then let's take off that volume profile for a minute. So if you look at this, we are below, we're not below the 50th, we're not correcting yet on the S&P, but we are in pullback mode because we are below that 17-week exponential moving average. The Qs are flirting with correction because we are, below that 50-week moving average and easily below the 17-week. And then finally, IWM is well below the 50. So again, we are in correction mode. Corrections when you fill in that gap. And we are on our way to filling that gap. And then another reason why I think we'll stop at the worst case scenario below that 50%. So we are well on our way to filling in that gap. We are easily below the 8-week, much less the 17. We've had our death cross there, intermediate death cross up between the 30 and the 50 weeks. I mean, we are bearish. We're in bearish mode. And when you look at the whole indicator, the whole moving average, you can see that, we've had a couple red arrows. We talked about in technical analysis class last week on our website that would probably get another bullish candle or two here early this week, because you can see the parabolic SAR is still easily way down here. We're still above the whole moving average, so we're not in danger of like flipping this anytime soon. So I expect we'll get a couple more days of just kind of sideways action as we stay up here in this area. So for SPY, it would be up into this area here. So we'll probably get a couple more bullish candles as we get as these really start speeding up and getting closer, and then eventually as the line moves up into the price, right, and then eventually turns around, that's when I expect that we'll roll that over. And I think we're a couple days away from that. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things: you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't like it. Also, while you're down there, comment. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching here on our blog, check out some of these other things over here on the right. If you click on this icon here, the Market Outlook Live, it takes you to this page on our site. This is where I do the Market Outlook Live video every Monday, Wednesday, and Friday at 3:30 Eastern Time. We do it on this page. I take a look at all the trades I've done in prior Market Outlook videos to see whether we should stay in them or get out of them. I also put on the trade from today that you'll hear at the end of the video. We've already done it today before the market closed in this video as well. So that's how you get to it. You can also come up here and click on Live Trade Review to see that. If you come down here, you can see our upcoming classes. Click on View More. That takes you to our calendar. You can see all of our upcoming classes as well as all of our recordings going back nearly 4 years there. You can also get to that by clicking on Trading Rooms there. Come down here, click on that heart. It opens up this tab. Hit that like button. Also click this thumbs up. Opens up another tab. Hit that like button. Again, the more you do that, we get our it helps us get our content out to more than just 37 people. There's a lot more than 37 people that follow my Facebook page, but not everybody sees this post. So the more people to see it takes more engagement. So that's why I keep asking for the thumbs up and all that. Twitter's the same way. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us right here while you're watching. All right, well, let's take a look at what we got going on here today. And you can see today was the day for gold. Gold really rallied. The dollar wasn't that bearish, but the gold was really strong today. And small cap stocks were strong too. They ended up the day relatively hot, relatively strong, much higher than like the Qs. The Qs were down 0.8%. Small cap stocks, and they pretty much had at the very beginning of the day, they pretty much rallied together. But from that point on, the Qs fell from being up 0.8% to being down 0.8%, whereas small cap stocks fell from being up 1% to being up 0.5%. Right? International stocks did better than U.S. equities. EFA outperforming EM. Commodities are rallied today. Again, you didn't have a whole lot of weakness in the dollar, but commodities rallied, and then long-term bonds were also up today. Finally, they've been kind of trying to figure out what they're going to do, right? Whether they're going to really break down or not. And we talked about the potential of this kind of blow off bottom or blow off top, if you're looking at it from a yields perspective. Very small day and small volume, not really getting a whole lot of follow through on this kind of breakout move on long-term bonds. Remember, IEF is a 10-year yield, and it didn't really move at all, right? So that's got even more of a blow off top kind of a move, even though you didn't get a significant amount of volume there, which again puts the big gap like that in question when you didn't even get average volume on a day like that. If you look at the U.S. dollar relative to the euro, the euro's made a big breakout move. It's been kind of consolidating those gains. The MACD is still positive and rising. We're still, easily above the 17-day moving average. In fact, the 8 and the 17-day moving averages now have we've been so bullish and held those gains for so long that your 8 and 17 are back above your 30 and your 50. And the 30, remember, crossed above the 50 over here. So, you've got a change in trend, at least from a dollar perspective, the whole, to make a move up back to this 200-day moving average to fill in that gap. Keep in mind that, that the strength in the euro is actually safe haven, right? In the past, it's typically the dollar that's safe haven, but the dollar's been so bullish while the market's been bullish during this bout of risk appetite that it's actually the euro that's become the safe haven trade from that perspective. Bitcoin followed up Friday's move with a big gain today, getting back above holding the break above the 17-day moving average and getting above the 30. You still got some gap to fill in there between the 50 and the 200. We just barely got that death cross. You typically always get a test of the 200 after a death or golden cross. So we'll see. This case, you actually went through it after the death cross. You went right through it. So we'll see if that ends up being the case again here. But this particular case, you actually have the point of control, some very significant resistance up above you. So we'll see how bullish this little bullish divergence ends up being on Bitcoin. Again, as a reflection of speculative risk appetite, right? The far end. I'm a little questioning about how much risk appetite there is, because you can see this is kind of another one of those proxies for speculative risk appetite, and did not do so well today, and still easily below its 17-day, and still moving down in this bearish, bullish convergence, but still in the bearish trend. So not really the big upside move that you would think. Okay, I can see that Bitcoin is showing us that things are getting a lot more bullish. Still a bunch of dark pink shading and red lines all across the board, whether it's the cyclical large cap tech, mega cap tech areas up here at the top, or even utilities and real estate at the bottom. Healthcare has got light green shading, but just barely. The only things that are positive, are staples to a degree, and financials and energy. And energy just continuing to really rocket to the upside. It's got by far the highest intermediate line out of anything right now. So it is very, very bullish. In fact, when you look at its directional movement index, you can see like we had a big spike up above 40 and almost below 10 on the negative directional index. Obviously, it's brought the ADX higher. And then again, you can see just how bullish we remain if you look at the RSI and the CCI down here. You can see also that we have been above the RSI for a good amount of time. The CCI is diverging with the peak there and the secondary peak over here. So you're getting this is kind of a little bit of a parabolic move right now. When you look at it on this indicator, you can see you're well above these moving averages, well above the 50, well above the 30, well above the 200. and the 8 and 17 day are relatively big too. In fact, when you look at the 8 and 17 day here, by default it pulls up to 1040. So let's go 817 exponential. When you pull up the PPO, you can see here. Let's get rid of all these others so we can kind of see the chart better on a better scale. Okay, so you can just see how bullish. I mean, it's pretty bullish. It's almost back to where it was on here on this initial thrust, and you can see very similar type bullishness over here too. And then, you know, that after we had that run back in March 15th when the Russell really outperformed, then energy, you can see, didn't go anywhere. Not that it won't, you know, not that it can't, you know, remember, it can not go anywhere and still really outperform the markets. But it appears that a lot of its gains are getting put in to its move right now, on at least on an absolute basis. Not necessarily, it's got a lot of gains to go on a relative basis to get overbought in the least bit. Let's take a look at the major economies out there, all these ETFs for all the major economies. And you can see China and India are doing pretty well. You know, we got light green shading on Russia and Korea. The European equities, you know, Italy's pretty bearish. Germany's more bearish. France is kind of up and down. UK is kind of up and down. Brazil looks really good, and Canada is kind of up and down. So not a lot of bullishness, but not a lot of bearishness either. So that's actually a good sign for international equities relative. I mean, the market appears to be rotating more and more towards the international equities. Like when you look at VXUS relative to VTI, and let's go to a daily chart, a 1 year daily chart on this. And let me come down here and put it on the daily PPO as well. I thought I put it on 1 year. Okay, there we go. So you can see the rotation is, you know, we've been so bearish. We are rotating back. We've kind of pulled back a little bit. The MACD is down. We are back above the 17-day moving average, even if the MACD is below its moving average. So we're still in this bullish convergence. But you can see a little bit better opportunity to break above the 200-day moving average on this relative strength than what we had on that initial thrust. And the PPO is still pretty negative, so a lot of opportunity for it to continue to move to the upside there. When you take a look at some of these other oscillators, like the trend, we look for a big spike here, like up into these high levels, to kind of signify that we've got a low point, at least to get the moving average up, to signify that we've got a low point. We don't have that yet. The skew is dropping down finally almost to 125. When you look at the new highs and the new lows, you know, these are updated. You can see we're still negative, but just barely negative there. This is what it looks like when you look at it from, let's see where to go, this perspective. You're still about 59%. So a little bit above 50%, but just barely above its moving average. So, you know, we'll see. We haven't really gotten down to the 35-40% levels that suggest that we've had this corrective move, and that corrective move is over with. All right, well, let's take a look at our trade idea for today. I want to take a look at Colgate, Palmolive. You can see Colgate's kind of in a bearish mode. Dark pink shading and a red line, intermediate lines below. The market sentiment line still very high. We're very weakly bearish. We don't have very strong short-term sentiment. It's not too bearish. You can see it's about as bearish as all these other little lows were. So nothing really significant. We're not really diving down hard here. We do have 3 red arrows. The MACD is negative still. It's been negative for a while. You can see it here on this chart. The MACD has been below its moving average pretty much since the beginning of the year. A few times attempts to get above the moving average, but it's still below it. Still below the 17-day. We are below the 30 and the 50 now, but holding the 200 for now at least. You can see, you know, we were below the 200 previously. We barely just got a golden cross on this. And remember how we talked about after you get golden cross or death cross, you typically get a retest of the moving average soon afterwards. Not always. You can see you didn't get one here. And you did eventually get one right there on that golden cross. So this could be the test of the 200 post golden cross. on Colgate. You can see you've got a big volume node above us. We got big volume down below us. So a nice kind of neutral candle from that perspective. When you look at the DMI, you got a little bit of a bearish pattern, but not a breakout. We're not breaking above 30. We're just barely above 25. We are below 20 pretty easily on the positive indicator. So we might not be breaking out to the downside, but we're also definitely not bullish either anymore. When you look at the Ichimoku cloud, we are into the cloud now, and you can see the green lines. The price is below the blue line, and so is the green line. Is below the blue line too. From an RSI and CCI perspective, pretty neutral territory. You know, little bearish on the CCI, but nothing significant. And easily above the 40th percentile there on the RSI. And then finally, when you look at the Bollinger Bands, we're pretty neutral, right? We are at the lower end of the Bollinger Band width, but the band width is also really small, and we're not breaking out and not pushing down against it either. So it's a bearish chart, but definitely not a bearish trending chart, and there's some easy support and resistance levels on either side. So when I look at setting up a trade on this, you can see what we'll end up doing here is selling. We already did this in a Market Outlook live video. We'll sell the 77.5, so low 20s in the delta, buy the 75, sell the 85, buy the 87.5, same idea. You can see at position size full for a full position because of the earnings, because we're through the earnings. If you notice my break evens here, those were those blue lines in the chart. So as long as we stay pretty much in the 52-week range, there's a little bit below there, but obviously there's some very strong support below that lower break even because of those lows. As long as we stay in the bulk of this 52-week range, then we stay in between these two very significant volume nodes, then that's how we make our money on this trade. It's a kind of an opportunity. We have a lot of iron condors that are expiring here next Friday in February. So this allows me to start putting some on for March, getting some neutral condors on there, some negative Vega trades in case volatility does continue to drop and move towards that 20 or below. I don't expect that it will, but in case it does, you want to have something there, a negative Vega, since a lot of the directional trades we've been doing are skew more towards positive Vega, which makes sense if volatility rises with any weakness in the market. But it allows us to put on some risk without a lot of deltas, right? So kind of neutralize out the directionality of my overall class portfolio. That includes, that this is just a handful. This is kind of a representative sample of all the trades that we do in our class portfolios, especially in this case, from my options trading classes combined with our technical analysis class for the timing. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.